Ever feel like you're just, constantly shelling out money for everyday things, doctor visits, maybe prescriptions, childcare, and you just wish there was a smarter way to handle those costs, like make them a bit lighter on the wallet? What if I told you there's a financial tool out there that could actually cut down those expenses and make tax planning simpler? All at the same time. Well, you're in the right spot. Today, we're doing a deep dive into flexible spending accounts. You probably know them as FSAs. Our goal here is really to unpack what FSAs are, how they actually work, and maybe uncover some of those, significant benefits they offer. Benefits for your finances, for expenses you're probably already paying. Before we dive deeper, though, just a quick reminder. This deep dive is based on material from Farhat lectures. All the content, the examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com. So whether you're maybe an accounting student, a CPA candidate, or already a professional, do check out the website. They've got extra practice questions, video lectures, detailed support, really good stuff to reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material for us. Okay, so let's get into it. How do these accounts actually work their magic? At its core, a flexible spending account. It's basically a special account, right? It lets employees put money aside straight from their paycheck before any taxes hit it. And this money, it's earmarked for specific qualified expenses. Think of it like setting up a dedicated fund, but with a tax advantage.
Exactly. And that pre-tax part, that is absolutely key. It's not just some small detail. It's really the heart of how an FSA saves you money.
Yeah.
Think about your gross salary, right? When you put money into an FSA, it's taken out before your income gets calculated for, say, federal income tax. It's like that chunk of your earnings just sort of bypasses taxation on the way in. So it immediately cuts down your taxable income right off the bat.
Okay. Pre-tax, I get that. But you said specific expenses. It's not for just anything, is it? What kind of qualified expenses are we actually talking about here?
You're right. It's targeted. The money you put in generally falls into two main buckets: medical-related expenses and dependent care-related expenses. So yeah, these accounts are really designed to help with those kinds of predictable but often pretty costly household things like health care and childcare.
Makes sense. And who can actually get one of these? Is it for everyone?
Generally, it's available to most employees
Hmm.
if their employer offers an FSA plan as part of their benefits. That's the catch. But it's important to know who can't get one. So self-employed folks, they're out. Unemployed individuals, also not eligible. You really need to be an employee of a company that provides it. It's tied to employment and the company's benefits package, unlike, say, an IRA you could open yourself.
Right. Okay, so it's an employee benefit. Now, who puts the money in? Does the employer chip in, or is it all coming from me, the employee?
Yeah, it's primarily funded by you, the employee. You decide, usually during open enrollment or when you first join, how much you want to contribute from your salary. That amount is then taken out of your paychecks, pre-tax, throughout the year. And there are limits. For medical FSAs, specifically, the IRS sets a limit. For 2023, for instance, that limit was $3,050 for employee contributions. Now, these numbers can change year to year, so you always want to check the current figures, but that $3,050 gives you a good idea of the scale. But while it's mostly employee money, employers can contribute too. It's less common, maybe, but it depends entirely on the company's plan. You might see a couple of scenarios. Some employers might put in a flat amount, maybe up to $500, especially if the employee doesn't contribute anything themselves. Or, and this is pretty generous, some employers might actually match what you put in, potentially up to 100% of that employee limit. So using that 2023 number, if your employer offered a full match, you could theoretically have had, $6,100 in your medical FSA? Definitely worth checking your specific company policy on that.
Okay, this is where it gets really interesting for, managing your money. Let's talk about those tax benefits. We keep saying pre-tax, but what does that actually mean for your bottom line?
It means real savings, actual dollars. So first, like we said, the money you contribute, it doesn't count towards your gross income for federal income tax. That's tax saving number one. But here's the kicker, the part people often miss: FSA contributions. They're also exempt from employment taxes. FICA taxes.
FICA, that's Social Security and Medicare, right?
Exactly. Social Security at 6.2% and Medicare at 1.45%. That adds up to 7.65%. That usually comes out of every paycheck. So with an FSA, every dollar you put in avoids both federal income tax and that 7.65% FICA tax. That's a really significant double tax saving.
Wow. Okay, so that hits your take-home pay right away then. But just to be clear, if the money goes in pre-tax, does it get taxed when you actually, take out or pay for stuff? That feels like where the catch would be.
That's a perfectly logical question. And the answer is, honestly, one of the best parts about FSAs. As long as you use those funds for qualified expenses, The medical or dependent care things we talked about, the reimbursements you get are not taxed either. So you really get this amazing dual benefit. Money goes in pre-tax, lowering your taxable income right away, and then it comes out completely tax-free when you use it correctly. A powerful 1-2 punch for saving money. Let's maybe walk through a quick example just to make it super clear.
Yeah, that'd be great.
Okay, imagine someone, let's call her Alex. Alex earns $80,000 in gross wages. And let's say her top tax rate, her marginal rate, is 25%. So every extra dollar she earns, 25 cents goes to federal income tax. Plus, remember that FICA tax rate, 7.65%. Now, Alex decides to contribute $3,000 to her medical FSA. Here's how the savings break down. First, the income tax savings. That's $3,000 times 25%, which works out to $750 saved right there. Then the FICA tax savings. That's $3,000 times 7.65%. That comes out to $229.50. Add those together. $750 plus $229.50. And Alex's total net savings are $979.50.
Wow, almost $1,000.
It's exactly. Just by setting aside $3,000 for expenses she probably would have paid anyway, Alex saved nearly a third of that contribution in taxes. And what's really key here is the impact on her taxable income. It drops straight from $80,000 down to $77,000. That's real money staying in her pocket.
That example definitely makes it concrete. Okay, so let's zoom in a bit on the medical FSA. What kind of things can you actually use that money for? What counts as a qualified medical expense?
Yeah, for medical FSA, the list is pretty broad, actually. It covers a lot of common healthcare stuff. Things like unreimbursed medical costs, think deductibles, co-payments for doctor visits or seeing specialists, prescription drugs, obviously. Also covers dental care, vision care, like glasses and contacts, and importantly, even medically necessary over-the-counter medicines and supplies. Things like bandages, pain relievers, that sort of thing. It's really designed to cover a wide range of those out-of-pocket health expenses.
Okay, so if I'm getting this tax break, putting money into the FSA, can I also then deduct those same medical costs on my tax return? Like on Schedule A, where you list itemized deductions. Is that possible? Like a double dip?
That's a really crucial point. No, you cannot double dip. Think of it like this. You already got the tax advantage when the money went in pre-tax. It wasn't counted as income then. So to also deduct it later on Schedule A, well, the IRS sees that as getting the same benefit twice for the same dollar.
Makes sense.
So yeah, once you use FSA money for an expense, you can't then claim that same expense as an itemized medical deduction. You've already received the tax benefit up front.
All right, fair enough. Now, let's tackle the big one for medical FSAs. That infamous use it or lose it rule. Everyone seems to have heard of this. How does it work? And more importantly, how do you avoid losing your money?
Right, the use it or lose it rule. It basically means that, generally speaking, you have to spend the money in your medical FSA within the plan year if you don't spend it by the deadline.
Poof, it's gone.
Pretty much. You forfeit any unspent funds back to your employer. The reason behind it is largely because FSAs are meant for current expenses, not long-term saving, like, say, an HSA. However, and this is really important, employers can offer ways to soften that blow. There are exceptions. One common option is a grace period. Often it's 2.5 months. So if your plan year ends December 31st, you might have until March 15th of the next year to spend down that remaining balance on qualified expenses incurred during the grace period.
Okay, that gives you some breathing room.
It does. Another option some employers offer, instead of the grace period, is a carryover. They might let you carry over a certain amount of unspent funds into the next plan year. For 2023, for example, the maximum carryover allowed was $610. Again, these numbers can change, but it means you might not lose everything if you have a small balance left. The key thing is you have to check what your specific employer offers. Some offer the grace period, some offer the carryover, some might offer neither. You need to know your plan's rules.
So thinking about tax planning, this really puts the pressure on estimating your expenses accurately, doesn't it?
Absolutely. It really highlights why you need to sit down and try to figure out your expected medical costs for the upcoming year. You want to contribute enough to get those great tax savings right, but not so much that you're scrambling at the end of the year or risk forfeiting money. Think about predictable things. Maybe you know you'll need braces or LASIK surgery or major dental work. Those are perfect FSA candidates. Or maybe you're planning to have a child, medical expenses will go up. Planning for those events with an FSA means you're essentially paying for them with discounted pre-tax dollars.
Yeah, getting a discount on braces sounds pretty good.
Doesn't it? And a quick practical tip for avoiding that use it or lose it panic. Know your plan rules, grace period, or carryover. Track your spending. Lots of FSA providers have apps now. If you see a big balance near year end, think ahead. Need new glasses, contacts. Time for that dental cleaning or filling. Stock up on eligible OTC items like pain relievers, first aid supplies, even sunscreen if it's medically necessary. Just be proactive.
That's really practical advice. Okay, let's switch gears slightly. There's another type of FSA, the dependent care FSA. What's the main goal of that one?
Right, the dependent care FSA. This one is specifically designed to help you set aside pre-tax money to pay for eligible dependent care services. Think childcare costs, basically. It helps cover the expenses that allow you, the employee, to actually go to work or look for work. Who qualifies for this care? Usually it's a child under the age of 13, or it could be a spouse or another dependent who lives with you and can't care for themselves due to physical or mental limitations. The key condition is that the care must be necessary so that you and your spouse, if you're married, can work, actively look for work, or even attend school full-time. And interestingly, the types of expenses covered daycare, after-school programs, summer day camp, they generally line up with the expenses eligible for the Child and Dependent Care Tax Credit.
Ah, okay, that's a good connection, the tax credit. So if the expenses are similar, what's the real difference between using the dependent care FSA versus just taking that tax credit when you file your taxes? Is one better?
That's a great question. And it often depends on your specific tax situation and, honestly, your cash flow preference. With the dependent care FSA, like the medical one, the big advantage is immediacy. Your contributions come out pre-tax, reducing your taxable income on every single paycheck.
So you see the savings right away.
Exactly. Lower taxes withheld, more take-home pay throughout the year. It helps with budgeting right now. The Child and Dependent Care Tax Credit, on the other hand, well, you have to wait. You calculate it and claim it when you file your Form 1040, usually months after the year ends. So the FSA gives you that immediate cash flow boost. The credit gives you a lump sum benefit later at tax time. For many people, especially those in higher tax brackets, the upfront savings from the FSA can be more valuable. Also, the tax credit amount can phase out at higher income levels. Generally, you can't use both for the exact same dollar of expense, so you usually pick the one that benefits you most.
Gotcha. And what are the limits for the dependent care FSA?
For the Dependent Care FSA, the contribution limit for 2023 was $5,000 per household. If you're married but filing separately, then each spouse can contribute up to $2,500. Oh, and an important point for divorced parents. Typically, only the custodial parent who incurs the expense can use this benefit. The non-custodial parent usually isn't eligible. And two other quick but important things about dependent care FSAs. First, unlike some accounts, the money in there doesn't earn any interest. Second, and this is a key difference from many medical FSAs, you can only get reimbursed up to the amount that's currently in your account balance.
Oh, really? So you can't spend ahead like you might with the medical one?
Generally, no. With dependent care, you usually have to wait for the funds to actually be deducted from your paychecks and build up in the account before you can submit a claim and get reimbursed. Think of it more like a regular savings account in that respect. You can only take out what you put in so far. If daycare is $500 a month and you contribute $200 per paycheck, you'll need a few pay periods to build up enough to cover that full $500 expense.
Right. That makes sense. Thinking about parents juggling work and childcare, saving any money on those daycare bills must feel like a huge win. This FSA really seems to target that need.
Absolutely. It's designed to take some of the financial pressure off those necessary but often really expensive aspects of working family life. It directly lowers the cost of being able to work or pursue your career.
Okay, so let's bring this all home. We've talked about pre-tax contributions, different types of accounts. What's the simple bottom line impact of using an FSA on your overall taxable income?
It's very direct. FSA contributions decrease your taxable income. Plain and simple. Let's use that $100,000 salary example again. If you earn $100,000 and you contribute, say, $3,000 total to your FSA's medical dependent care, whatever combination your taxable income for the year effectively becomes $97,000. That $3,000 is just removed from the calculation before federal income tax and those FICA taxes are figured out. It means immediate savings right back in your pocket.
So really, FSAs are these powerful, maybe often overlooked tools. They help you save real money on taxes just by using pre-tax dollars for essential things you're probably paying for anyway. It's about making your money work smarter. So, just to recap our deep dive, flexible spending accounts, FSAs, they offer this really fantastic way to turn necessary costs, medical bills, childcare into real tax savings. If you understand how they work, plan carefully, you could genuinely put hundreds, maybe even thousands of dollars back into your own pocket each year, money that would otherwise just go to taxes.
Yeah, and that really leads to an important question for you, our listener, to think about. If you look at your expenses for the upcoming year, both the ones you know about and the ones you anticipate, have you really maxed out the potential tax savings from an FSA? Are there things you're planning to spend on? Maybe it's new glasses. Maybe dental work is finally happening. Maybe summer camp for the kids that could be paid for with these pre-tax dollars, giving you a substantial discount you just wouldn't get otherwise.
Exactly. Something to definitely consider. We hope you'll take these insights and see how they might fit into your own financial planning. An FSA could really be that smart move you need to make your money stretch further.